Tel Aviv, 7:12 a.m. Your coffee is still hot when the alert hits. You're 42. You manage logistics for a mid-sized importer. You've built $85,000 in savings, half in shekels at your local bank, half in a U.S. ETF you chose for stability. You don't chase upside, you defend downside. Then, confirmation. Israeli strikes on Iranian-linked targets. U.S. involvement signals escalation. Within minutes, oil jumps 12%. Not just a commodity move, a global pricing shock. Nearly 20% of the world's oil flows through a region now under direct military tension. Gold surges 3%. The shekel drops 4% in 2 days. U.S. bond yields fall 25 basis points as global capital moves into treasuries. Volatility spikes above 30. You refresh. Your currency weakens. Energy costs reprice. Liquidity tightens. You try to rotate into dollars. Spreads widen. Execution slows. Your Turkish supplier messages. Freight rates revised. Insurance recalculated. Payment terms shortened. What looked like a regional conflict is now embedded in your cash flow. This isn't distant geopolitics. It's global energy supply. It's sovereign funding pressure. It's capital repricing in real time. By noon, oil is influencing shipping contracts worldwide. By afternoon, your ETF is green, but your operating costs are climbing faster. By evening, institutional money has already repositioned across currencies, bonds, commodities. Not from panic, from structure. When the U.S., Israel, and Iran collide, the shock doesn't stay regional. It moves through oil, through the dollar system, through sovereign balance sheets, and into household savings. And here's the part most people miss. By the time the public understands the risk, the protective assets have already moved. In this video, you'll see the 5 asset classes that consistently surge when geopolitical stress escalates, and, more importantly, the structural triggers that send capital there first. Because in moments like this, waiting isn't neutral. It's expensive. Money rotates before headlines stabilize, and the clock is already running. What you just watched on that screen isn't random volatility. It's a sequence, and sequences can be understood. In the next few minutes, we're going to break down the 5 asset classes that consistently surge when U.S.-Middle East conflict escalates. Not because investors panic, but because capital follows structural pressure. You'll see why liquidity moves first, why insurance assets spike second, why energy scarcity reprices faster than wages adjust, why sovereign bonds behave differently from equities, and why some safe positions quietly become fragile. More importantly, you'll understand the trigger points, the signals that tell you rotation has already begun. Because when oil shocks ripple into the dollar system, when funding markets tighten, when volatility jumps, money doesn't debate ideology. It reallocates. And here's the uncomfortable truth. If you can't identify where capital migrates under stress, you become the liquidity for someone who can. This isn't about predicting war. It's about recognizing structure. By the end of this video, you won't just know which 5 assets surge. You'll understand why they surge first, and what that reveals about the next pressure point in the system. Because in geopolitical stress, survival isn't about speed. It's about position. When missiles move, markets don't wait for speeches. They price constraint. A direct U.S., Israel, Iran escalation doesn't stay regional. It hits 3 pressure points immediately, and they travel through the entire financial system. First, energy flow risk. Nearly 20% of global oil passes through waterways now sitting inside the conflict radius. When oil jumps 10 to 15% in hours, that's not speculation. That's the cost of possible disruption being pulled forward into today's price. And energy is not isolated. It's in shipping. It's in fertilizer. It's in airline fuel. It's in food on supermarket shelves. Second, financing costs. Insurance premiums rise. Freight contracts reset. Governments that already carry heavy debt face higher funding sensitivity. What begins as a military strike becomes a borrowing question. Third, liquidity. When uncertainty spikes, Investors stop chasing return. They chase access. They want assets they can sell instantly, in size, without permission. Now, bring it down to you. If you earn in a currency that weakens 3 to 5% in days, your imported costs rise before your income does. If you hold long-term bonds, prices may pop briefly, but inflation risk doesn't disappear. If you run a business tied to local demand, fuel and insurance squeeze your margins first. If your revenue is linked to commodities, your cash flow may jump, but volatility follows close behind. Conflict doesn't erase wealth. It shifts the advantage. And shifts happen fast. Energy reprices, credit adjusts, liquidity migrates. Miss the first rotation, and you finance the second. The first asset that surges in a geopolitical collision like this isn't dramatic. It's not gold, it's not oil, it's the US dollar. Not because it's perfect, because it's liquid. When tension rises between the US, Israel, and Iran, the dollar system sits at the center of global trade, energy settlement, and sovereign reserves. Oil is priced in dollars. Global debt is largely denominated in dollars. Cross-border transactions clear through dollar-based networks. So, when uncertainty spikes, capital doesn't look for the highest return. It looks for the deepest exit. That's the dollar. You see it immediately in funding markets. Dollar demand rises. Treasury yields fall as buyers rush into the most liquid sovereign market on earth. Emerging market currencies weaken. Dollar-denominated debt becomes heavier in local terms. This is not patriotism. It's plumbing. Now, zoom in. If your savings sit in a smaller currency, and that currency drops 4 to 6% in days, your purchasing power against global goods shrinks instantly. Imported electronics, energy, raw materials, all reprice upward before wages adjust. If you carry dollar debt while earning in a weakening local currency, your balance sheet tightens without you touching it. If you hold U.S. Treasuries, prices may rise as yields fall, but that safety is tied to liquidity preference, not long-term stability. And here's the uncomfortable part. The dollar strengthens not because the world feels safe, but because the world feels unsafe. In moments of geopolitical fracture, the asset with the widest door wins. Liquidity concentrates. Funding tightens. Pressure exports outward. The dollar is not a vote of confidence. It's a vote for access. And when access becomes scarce, the strongest currency doesn't just rise, it pulls capital toward itself and drains it from somewhere else. That drain is where the next stress forms. If the dollar is the world's liquidity valve, gold is its insurance layer. When conflict escalates in a region that powers global energy supply, trust doesn't vanish in a day. It weakens, and gold tends to rise as that weakening spreads. Unlike the dollar, gold doesn't pay interest. It doesn't depend on corporate profits. It isn't backed by a government promise. Its role is simpler. It sits outside the credit system. When investors worry that currencies, banks, or sovereign balance sheets are under strain, they look for something that doesn't rely on any of them. When oil jumps sharply, inflation pressure usually follows. If prices start rising while bond returns don't keep up, holding cash or long-term bonds becomes less attractive. That's when gold begins to compete. No issuer, no repayment risk, no balance sheet exposure. That's why, in the early days of serious geopolitical tension, gold can move quickly, sometimes before stock markets fully adjust. But here's what matters. Gold doesn't surge because war guarantees disaster. It rises because the range of possible outcomes suddenly gets wider. More uncertainty, more downside scenarios, more demand for protection. Bring it down to your balance sheet. If your savings are tied to one banking system and one currency, gold represents value that isn't linked to either. If you own long-term bonds and inflation risk increases, gold becomes an alternative store of purchasing power. If you hold equities sensitive to rising costs, gold miners can magnify the move, up or down, and timing matters. Gold often makes its sharpest move in the first wave of escalation, when institutions reposition quickly and retail investors are still processing headlines. Insurance reprices fast. Arrive late, and you're not reducing risk. You're paying for it. Gold isn't a bet on collapse. It's a response to thinning confidence. And when energy shocks, currency pressure, and sovereign stress begin to overlap, that thinning becomes visible in ounces. If the dollar absorbs fear and gold absorbs doubt, energy absorbs shock. When conflict enters a region that carries nearly 20% of global oil flows, markets stop asking who is right. They ask one thing: will supply move tomorrow? If the answer is uncertain, oil reprices instantly, not gradually, not politely. A 10 to 15% jump in days isn't a headline reaction. It's the cost of possible disruption pulled forward into today's price. And oil doesn't stay in the energy sector. It moves into freight contracts, into airline fuel hedges, into fertilizer production, into grocery bills. Energy producers feel the upside first. Revenue per barrel rises. Cash flow accelerates. Earnings expectations reprice almost immediately. Defense contractors follow a similar path, but for a different reason. When geopolitical tension escalates between state actors, procurement cycles shorten. Budgets that were debated become urgent. Backlogs stretch further into the future. This isn't moral, it's mechanical. Scarcity raises prices. Threat raises spending. But here's the nuance most viewers miss. Energy equities often move before actual supply is disrupted. They price possibility, not confirmation. And when that possibility fades, even slightly, those gains can unwind just as fast. Oil spikes on escalation. Oil drops on de-escalation hints. Timing is unforgiving. Now bring it to your balance sheet. If you run a business dependent on fuel, your costs rise immediately. But your customers won't accept price increases overnight. If you hold broad equity indices, energy gains may cushion declines elsewhere, until volatility reverses the trade. If your country imports most of its energy, your currency can weaken as trade deficits widen. Energy is not a safe haven. It is a volatility amplifier. Arrive early, and you benefit from repricing. Arrive late, and you fund the unwind. When disruption becomes the driver, exposure decides everything, and exposure rarely announces itself before it hits. After liquidity runs to the dollar, after insurance flows into gold, after disruption lifts energy. Capital doesn't always chase the next spike. Sometimes it pulls back. It parks. That's where short-duration sovereign bonds enter the rotation. When geopolitical tension rises, large institutions don't just look for safety, they look for control. Long-term bonds lock you into years of exposure. If inflation lingers, if fiscal spending expands, if borrowing needs grow, those long maturities can swing hard. Short-term government bonds offer something different. They mature fast. They reset fast. They exit fast. In unstable moments, speed matters more than yield. Watch the yield curve during escalation. Demand builds at the short end. Prices firm. Yields compress. Institutions reduce exposure to assets that could trap capital if conditions shift again. This isn't confidence. It's caution with flexibility. And flexibility at scale changes the system. When pension funds, insurers, and global asset managers shorten duration, they are quietly reducing their time commitment to growth. They're saying, conditions are too uncertain to lock in. That behavioral shift matters. If you hold long-dated bonds and inflation expectations creep higher because energy remains elevated, price swings increase. If you depend on stable retirement income, longer maturities become more sensitive to policy shifts. If your government already faces rising interest expense, heavy demand for short-term debt can signal that investors are unwilling to lend long. Short-duration bonds move quietly, less dramatic than oil, less visible than gold. But they carry a message. Institutions are staying close to the exit. When the largest pools of capital choose to wait instead of invest, expansion slows next. Risk appetite narrows. Funding becomes more selective. Duration compresses. Horizon shrinks. Commitment fades. Short-term sovereign bonds are not a bet on stability. They're a hedge against being stuck. And when capital prioritizes escape over return, That tells you something deeper. The room may look calm, but the exits are being mapped. Stay long while they go short, and you inherit the volatility they avoided. If liquidity runs to the dollar, if doubt flows into gold, if disruption lifts energy, if capital shortens duration, the final rotation often hides in plain sight. Food, fuel, inputs, strategic commodities. When conflict touches a region tied to energy corridors and shipping lanes, the shock doesn't stop at crude oil. It moves into natural gas contracts, into fertilizer production, into grain exports, into the cost of feeding populations. These markets are thinner than oil, less liquid, more sensitive to bottlenecks. That's what makes them dangerous. When insurance premiums rise and shipping routes adjust, wheat doesn't need a failed harvest to spike. Fertilizer doesn't need a factory to explode. LNG doesn't need a terminal to close. The mere risk of interruption can push prices sharply higher, because global inventories are often tighter than people assume. Scarcity reprices fast, and food inflation travels politically. Now zoom in. If your country imports grain or gas, a 10 to 20% move in global prices doesn't stay in commodity charts. It moves into electricity bills, grocery receipts, public budgets. If you operate a business tied to transport or agriculture, margin pressure compounds quickly. If you hold sovereign bonds in a food importing nation, fiscal stress can accelerate as subsidies expand. And here's the subtle spike. Strategic commodities often move after oil, but before policymakers respond. They are the second wave of pressure, quieter at first, then persistent. Energy shocks headlines. Food shocks households. By the time the impact becomes visible in consumer inflation data, positioning has already adjusted upstream. These assets are not glamorous, they are essential, and essentials don't wait for permission to reprice. Miss the second wave, and the cost shows up where it hurts most, on balance sheets and at kitchen tables. Here's the part that unsettles most viewers. In many geopolitical escalations, even when the United States is directly involved, U.S. equities often recover faster than the markets closest to the conflict. Not because risk disappears, because capital concentrates. When uncertainty rises globally, the deepest equity market on Earth becomes a magnet. Pension funds in Europe, sovereign wealth funds in Asia. Institutions everywhere that need scale and liquidity rotate into what they perceive as the most resilient corporate ecosystem. It feels counterintuitive. War headlines intensify. Oil remains elevated. Volatility spikes. And yet, large-cap U.S. equities stabilize first. Why? Because global capital doesn't just seek safety. It seeks depth. Now, zoom in. If you assume conflict automatically destroys all equity exposure, you may exit into volatility, just as institutional flows rotate back into concentrated markets. If you assume recovery signals stability, you may ignore underlying pressure building elsewhere, in energy importing nations, in weaker currencies, in sovereign balance sheets. The shock isn't that markets move, it's where they move. Risk doesn't disappear, it relocates. And if you misread relocation as resolution, you don't just miss the signal, you become part of the transfer. Now, widen the frame. Today's system is not entering this conflict from a position of excess stability. U.S. federal debt sits above 120% of GDP. Interest expense consumes a growing share of tax revenue. Energy markets remain globally interconnected. Supply chains are leaner than they appear on the surface. Add geopolitical escalation to that baseline, and the pressure compounds. If oil sustains elevated levels, inflation expectations harden. If inflation hardens, central banks face a constraint, tighten policy into geopolitical stress, or tolerate higher prices. Neither option is frictionless. If sovereign borrowing needs rise while rates remain elevated, funding sensitivity increases. Markets begin to differentiate more aggressively between countries with strong balance sheets and those without. Watch the signals. Energy spreads, currency volatility, shortening bond duration, capital concentration into deeper markets. These are not predictions. They are stress indicators. And here's the tension. If conflict amplifies fiscal spending while debt loads are already heavy, something adjusts. Either borrowing costs, or currency value, or growth expectations. Arithmetic doesn't pause for diplomacy. Now ask the structural question. When large economies enter geopolitical strain with high debt, tight funding cycles, and energy exposure already elevated, where does the next layer of pressure migrate? It won't announce itself in a speech. It will appear in spreads, in funding auctions, in currency crosses. Pressure doesn't vanish, it redistributes. And redistribution leaves footprints for those watching closely. Step back and look at the sequence. First, liquidity runs to the dollar. Then, doubt moves into gold. Shock lifts energy. Capital shortens duration. Strategic commodities tighten. 5 rotations. Not random, layered. Each one responding to a different form of pressure. Access, trust, disruption, optionality, necessity. And none of them are emotional. They're mechanical. When geopolitical stress hits a system already carrying high debt, tight funding cycles, and fragile supply chains, capital doesn't freeze. It prioritizes access over yield, insurance over growth, scarcity over comfort, flexibility over conviction. That prioritization carries consequences. If liquidity concentrates, smaller currencies strain. If energy stays elevated, margins compress. If institutions shorten duration, long-term investment slows. If food and fuel reprice, political pressure follows. Rotation is not resolution, it is redistribution, and redistribution means someone absorbs the cost. Missile headlines fade. Balance sheet effects linger. Here's the uncomfortable truth. By the time the rotation becomes obvious to the public, it is already mature inside institutional portfolios. Late positioning isn't defensive. It's reactive. And reactive capital pays spread, pays volatility, pays timing error. 5 assets surge. But they surge because something else tightens. And tightening rarely reverses without leaving marks. Conflict doesn't destroy wealth evenly. It reallocates it. When uncertainty rises faster than income stability, capital migrates toward liquidity. When inflation risk rises faster than bond returns, insurance assets gain relevance. When supply risk rises faster than production capacity, commodities reprice. When fiscal strain rises faster than growth, duration compresses. No prophecy, just arithmetic. The U.S.-Israel-Iran axis is not merely a regional flashpoint. It intersects with energy flows, sovereign debt loads, and global capital plumbing. That intersection forces prioritization, and prioritization exposes fragility. The 5 assets you've seen are not winners. They are signals. Signals that the system is under stress. Signals that time horizons are shortening. Signals that optionality is becoming expensive. When capital chooses access over return, protection over expansion, flexibility over commitment, the message is clear. Stability is conditional. Liquidity is prized. Exposure decides outcome. And in moments like this, survival isn't about predicting headlines. It's about recognizing migration. Because when the rotation starts quietly, and you notice it late, you don't just observe the shift, you fund it.